What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today, I'm joined by Bob Elliott, CIO at Unlimited Funds and portfolio manager of the ETF HFND. Bob is a former IC at Bridgewater and brings a wealth of knowledge about the macro environment and economic landscape. Today's discussion will focus on why the S&P and NASDAQ continue to surge into all-time highs, the underperformance of small caps, and the necessary factors for small caps to align with the broader market. We will delve into the noteworthy shift from the Federal Reserve being the primary market narrative to the emphasis on earnings projections. Bob will provide insights on his 12 to 24-month forecast for the U.S. economy and where he sees trade opportunities between now and the U.S. presidential election. Let's get started. Today's podcast is sponsored by TradeStation. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures markets. Enjoy intraday rates as low as 10% on select U.S. index futures. TradeStation is also cutting margin rates in half for popular energy products, crude, heating oil, gasoline, and their associated minis. Open an account and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Visit tradestation.com/Anthony to learn more. Bob, welcome back to the show, buddy.
Thanks so much for having me.
Well, markets are another day in the markets, another new high. Why are we even doing this show, Bob? Like we said, we should just tell everybody to go max long equity indexes and just let it go.
Yeah, man. 3 times levered NASDAQ is the way to go. And, stop thinking about it. Just go for it forever. What could
Bob,
go wrong?
Yeah, right. Why do you think that equities are rallying so much? I should say S&P and NASDAQ, not Russell, which we'll get to that.
Yeah, I mean, if you look under the hood, you've got a couple companies that are obviously driving a lot of the incremental performance, though I think sort of in general, it's not like it's a story, the macro story. I think a lot of people get focused on the micro story, although the macro story is really one in which there's pretty strong growth expectations going on in the economy right now. I think we've had people thought that there was going to be a terrible recession, 100% certainty of recession. It didn't transpire that way, and it hasn't really transpired in the last 2 years. And so I think in a lot of ways, expectations are catching up. Like, we entered this year with expectations that U.S. growth would be below 1%. It's now those expectations are closer to 3% for the rest of the year, 3% real growth. And I think there's a lot of extrapolation that sort of economic environment will continue, that nominal growth will be strong, earnings growth will be strong, companies will take on increased margins. And of course, a lot of that's accruing to a small number of companies. But the big picture story is, everyone's expecting something like 18% earnings growth year over year by the end of Q4 2024. And it's not just NVIDIA. It's the 493 coming in with meaningful earnings growth as well. So it's just a really strong, very high expectations of growth ahead.
Bob, you're one of the guys I could talk to about whether it's just a market story or it's also followed up by a strong economy. Because as a trader coming up in this industry, it's always been, well, the market is going to do what it's going to do, kind of not regardless of the economy, but it can do whatever it wants for a period of time before eventually the economy really matters. Is this a market story and an economy story, or is this just a market story right now that eventually we start to see actual pullbacks or stalling in rallies because the economy is maybe not as strong as everyone thinks?
Yeah, well, I think the expectations are in some ways a market story, but those expectations are also an economy set of expectations, right? Like, it's not just a desire to pay more for future earnings. Analyst expectations of earnings are rising, reflecting the fact that there is an expectation of very strong earnings growth ahead. And the way that happens is through the real economy delivering those earnings growth. And so I think that's the interesting story about this, is that it's not just, a market getting bulled up, but it's a market getting bulled up on expectations of fundamentals. And so when you go talk to people, who are very much bulls, they're penciling out, double digit or even high double digit earnings growth over the next couple of years. And getting to the sort of valuations, the sort of returns like S&P 500 6,000 or something like that. They're like getting to those numbers from earnings growth. Now, the question is, how does that earnings growth get delivered? And can it be delivered that strong in earnings growth? Like, you basically have to, basically, what's baked into the market and those expectations is that, the biggest companies in the US economy are basically going to take all the revenue, right? They're going to take all the margins, all the revenue. Um, and they're going to leave the rest of the economy in the dust, because it's the only way they can get the sort of margin expansion that's needed, even with pretty good growth, 5 or 6% nominal growth, which in the US case is pretty good, all things considered these days. The only way you're going to reach those sort of earnings growth expectations is with big margin expansion. And so the only way that's going to happen is if those companies take share from the rest of the US economy. It certainly could happen, but it really raises questions about whether, that from a fundamentals perspective, whether we're going to get there.
So it comes down to, I think part of the story is that because expectations were set low and now earnings are coming in and people are increasing their expectations, that is why the market has become really just this one-sided rally. Is it because people are playing catch up because people had expectations too low and now so it's sort of chase just to get in because I have to be in?
Yeah, well, in part, I mean, that said, if you just look at S&P 500 earnings over the last 6 quarters, 6 or 8 quarters, like, you're certainly not seeing double-digit earnings growth over the last 6 or 8 quarters on the S&P 500, right? Like, if anything, actual earnings, have been pretty mediocre over the last year and a half or so. And so, I think what's happening is that people are extrapolating, um, that the economy is not going to be terribly weak. There's a lot of concern about the economy being terribly weak, resetting their expectations to being strong, and extrapolating growth that's happened, that's price growth, like positive, strong returns, that has predominantly come from, not from earnings growth, but from resetting multiples. Multiples going higher, and they're then extrapolating that into saying, well, because those multiples essentially have gone higher, then what we're now going to see is we're actually going to see the earnings that match the multiples that we're seeing. And of course, there's certain companies where that's happened, like, Nvidia has actually gotten at least reported earnings that are not that far off of what those multiples were in terms of in terms of what's going on. But that's few and far between. In aggregate, the S&P 500, the earnings growth situation is basically flat for the last 18 months, and multiples have been driving the expansion. And now people are saying that, it's going to be earnings in the future. It's pretty hard to see from a macro perspective how it adds up.
So does it worry you that the market is being led by just a handful of stocks?
Well, I think from a macro perspective, as a macro investor, essentially there's always winners and losers in a stock market. And so I think you get caught up in, oh, is this just a Nvidia story, or just a this story, or just a that story? Like, when it comes to an equity market, there's always going to be people on the right side of the tail, left side of the tail. That's the way it works. It is more concentrated, in terms of market cap and things like that, than it has been in the past. And so you essentially, when you're thinking about those earnings expectations, there is more concentration to a smaller number of companies to continue to deliver those earnings. But the reality is that what's expected, is in part going to come from those sort of high flying stocks, but also a big chunk of it, more than half of it, is expected to come from the S&P 493. So the rest of the market has to deliver in terms of the real earnings outcomes in order to justify the continued appreciation of these companies. And so I think one of the things that's interesting in the market right now is you're seeing a lot of people say, well, stock prices are justified because earnings expectations are rising, right? That they're pointing to those earnings expectations as justification for the current price level, but the earnings expectations haven't been delivered. They're not pointing to earnings as the thing that's driving the price increase. They're pointing to earnings expectations as justifying what's going on. And those two things are very, very different story. If we have a continuation, if we have 5% earnings growth over the next 24 months, that'll underperform what bottoms up analyst expectations are by 20%. Right. So that's a pretty big difference in terms of that. So there's a lot of betting that, that those earnings are going to get delivered the way that they're currently priced in or expected.
Well, that's like a day trader going out there, developing a strategy, and then looking at it on a simulated environment and seeing what it's done. And then when it goes live, it doesn't do quite as well. If it doesn't, well, then, you set yourself up for potentially, I don't want to say disaster, but your expectations of it doing well have now turned into, well, what do I do? And now it could be chased the opposite way to where you're like, well, maybe rethink this again. What I find so interesting, Bob, is that you have such low expectations about the economy and the market. And then as time goes by, you see expectations now getting on the opposite end of that spectrum. And along the way, the market continues to grind higher. And I guess so it really seems to me as though that what will really tell us if this tape is for real, I think, is less about the Fed. Maybe we'll get into that right now, is that although that seems to be the story that everyone consistently talks about, it's going to be more about what earnings are going to do next quarter. Because if earnings are not being justified based upon the expectations that are being set, that is something that all index traders and traders have to really keep their eye on, maybe even more so than the Fed.
Yeah, I think that's right. Like the reality is the Fed story on let's say the next 12 months, there's nothing really interesting going on with the Fed. Like the Fed's not going to do much.
Finally, Bob,
whatever.
Finally. It's not,
finally,
it's finally not the big story. Yeah.
It's not. No, I really don't think it's a big story because, like, look, are they going to cut one time this year, two times this year, three times? It doesn't make any difference. Doesn't make any difference to what's going on. With the current state of the economy and inflation, et cetera, they're not going to be hiking interest rates anytime soon. And they're also not going to cut 6 or 8 times, the magnitude of cuts that would be necessary for them to meaningfully, influence asset prices, influence the economy in a material way. And so, in some ways you sort of like can take that out of the equation as an investor right now. And it really does come down to that real economy and the real outcomes price. I think, in some ways the dynamics that are going on right now are the fundamentals are better than where we were obviously back in the 2000 bubble. But the dynamics, some of the dynamics, particularly around the equity price dynamics, are similar in the sense of a continued increases in expectations of earnings that then at some point just don't get hit, which creates a price change in the equities. And so it's not like if you go back to the late 90s and early 2000 period, it's not like growth was particularly bad. In fact, like unemployment only started to meaningfully rise quite a ways after the stock market fell. The way that dynamic worked is that expectations got to be relatively extreme, not really of earnings, because a lot of those companies didn't have any earnings, but really around sales and future growth prospects. And then those companies just didn't achieve those future growth prospects, and that created a re-rating of the price, which created the a reinforcing downward dynamic, which then fed through to the real economy. We can have the same sort of dynamic occur. Now, of course, it's not as extreme, but you'd have the same sort of dynamic occur, which is, say, earnings are basically flat over the course, or up in the single digits, in the low to mid single digits over the course of the next 12 to 18 months. If expectations are so elevated, even with modestly, like pretty good, fine earnings growth, if you don't hit those expectations, prices re-rate, and that creates the second and third order consequences. And that's, of course, not to even raise the possibility of the risk that actually we have a more meaningful economic slowdown after years of tight money in place.
So I want to stay on the Fed just for a second, because you saying that if they cut once, twice, even 3 times, it doesn't really matter. And I actually think as a trader, I think it's refreshing to hear that the Fed is not the story right now. I really do, because for how many years now, we're so held by what the Fed is going to do, what they say, dot plots, and you're just like, dude, I'm over it, right? I mean, because we're just so held by a word in a statement, and how that sends us in a trajectory one way or the other just makes it very difficult. And now the fact that you're saying that it's we have to watch the earnings and we have to see what the expectations are. And we talk about the multiples and the way that people are looking at the market, I think is very, very important to note. But why does the Fed only cutting once, twice, or three times not really matter?
Well, in the same way, the Fed's tightening of monetary policy hasn't really mattered to the real economy over the course of the last couple of years. And it's because the economy isn't particularly sensitive to the short-term interest rate. And that's, that's sort of a longer term conversation to be had around how the U.S. economy in particular, was restructured after the global financial crisis. Debt growth and credit growth became less meaningful in terms of the driver of the economy. And, debts were meaningfully restructured into essentially long-term debts, refinanced at low interest rates. And there's not that much debt coming due. Now, if you think about it, if you're a household with, you own your car that you bought years ago, you own your house, you have a 2% mortgage, and you're working a job and getting a 5% wage increase year over year, like, what does the interest rate have to do with anything that you're doing? Like, literally, it has no impact on you, right? Interest rates could be 2%, they could be 5%, they could be 10%. Like, it doesn't make any difference to you, right? Because you're just, in general, taking in incremental income, paying out your mortgage, which is fixed, and then spending out of your income. And that's the story. That's the macroeconomic story. And so in that sense, it doesn't really matter exactly what the Fed does. Now, on the margin, to the extent that they run tighter for monetary policy for longer, that could start to influence the long end of the curve. Although, as I said, by and large, what's priced into the market right now, which is one, depending on the day, one or two cuts through the end of the year and a few cuts into 25, like, it is likely going to be in that ballpark unless there's a meaningful growth contraction. Of course, if there's a meaningful growth contraction, we go back to our conversation about stock. Like, the Fed cutting isn't going to matter. The Fed is going to cut rapidly if earnings contract rapidly. And if earnings don't contract rapidly, the Fed's not going to matter, right? So that's basically the situation that we're in.
Got it. I was thinking of it more from the U.S. inflation outlook. I mean, you recently mentioned on X the importance of not flipping an economic view based on 1 month of data. Wait, Bob, but this is the most important CPI of our lives, right? We heard that for every month, right? But the question is, how do you interpret the recent U.S. inflation data? And do you see it as an outlier, or is this a new trend?
Well, we've certainly gone from a period where inflation was at, depending on what measure you're looking at, something in the 5, 6, 7% range to something that's closer to the 2 to 3% range. That's basically where we're at right now. And even though, like, we spend a lot of time like squinting, is it like 2.8 or 2.7 or 2.9 or whatever? Like, who cares? Like, it's at some level, it's still a bit elevated. It's a little high for the Fed's preference. Basically, it will remain unless there's some sort of unexpected shock. It will likely continue to be elevated relative to the Fed's preference. And that elevation is the thing that is an important consideration when it comes to the Fed not proactively cutting. I think we came into 2024, a lot of people were essentially trading off of or keying off of Waller's comments that they were going to do an easing in order to contain in order to bring what was perceived as real rates down. And that was essentially, in some ways, you could look at that like a proactive easing, right? Even though, the economy didn't deteriorate, they were going to proactively ease. I think the fact that inflation has stabilized here at a level that is a bit above where their target is, and the Fed's response, even the dot plot, gave some indication, shifting to only one cut rather than two cuts, rather than three cuts in the most recent dot plot, all points in the direction of like, look, inflation is a little too high. We're not going to proactively ease. And so, expect this monetary policy position that we're going to be in, expect it for a long period of time. And honestly, like, you'd be a lot better off just like stop listening to certainly stop listening to the Fed and certainly stop listening to those governors. Like, they have no idea what's going on, and they certainly have no idea what future monetary policy is going to be. And so, like, you're much better off just not listening to them and just kind of pencil in the Fed. It's like, it's going to be hot, rates will be elevated. They're not going to proactively ease unless growth slows, and just like and move on. There's other things that are more interesting to be thinking about these days.
I love that you're saying this, Bob, because I think that for so many traders out there and investors, they're trying to read the tea leaves of what the Fed is going to do. And from watching your posts on X, listening to your other interviews, hearing you today, it is not the primary reason the market is moving and doing what it is right now. And I think it's so important because traders get so caught up into what is that macro theme, what is driving this. And you see so many people talking about, well, the Fed's getting ready to cut rates, or, the Fed was raising rates, we couldn't go higher. And all these things, I think, really get into their subconscious. And it's caused a lot of traders to struggle, I think, because it's the environment that we've been in for so long, and to remove ourselves from that, just like it was. I remember when we got into where all we watched was the Fed, I couldn't wait to be out of it. It's like that breaking up with your girlfriend or that divorce from that. You're like, I still feel like there's this connection there, but do I just remove myself from it? And so I want to go to really how you view the current stance of the Federal Reserve. What impact do you think their policies have had on inflation, growth, and on bond yields? Where do you see them in the coming months?
The Fed's actions and just more generally, like monetary policy and the repricing of interest rates in the economy. Basically, we went from a period of very, very low interest rates for a long period of time to a period of recognition that, hey, interest rates are not going to be, nearly as low as they were in the post GFC period, for a variety of different reasons. Both the economy has healed and is stronger than it was then, as well as the fact that, we're seeing inflationary pressures. And so that created a reset of interest rates. But if you really look at it, like, what have 2-year bonds done, 2-year bond yields done over the course of the last, 2 years? They've basically been in the same range, right? Reset to a higher level. The 10-year bond has basically been in the same range. There's a lot of conversation. Is it 430 or 475 or whatever? But like, we were at, under 2, and now we're at 4 to 5, right? And we've basically been in that range. And if anything, like, it's been sort of range bound. Like, you've been better off fading extreme expectations, either bond yields particularly high or bond yields particularly low, or the Fed tightening a lot or not easing at all, or versus the Fed, easing a lot. Like, you've been much better off the last 2-ish years fading those wiggles, because there's not a lot of information value in the wiggles. If anything, it's just people's expectations that are like flipping around, that are much more volatile than the economic reality. And the economic reality is we're in a higher interest rate environment. The economy was very strong 2 years ago, coming out of COVID, and with very high income growth to households. Tighter monetary policy, and plus the natural sort of meeting the economic, the limits, the economic capacity in the economy, has meant now that growth is slowing down modestly. And we're sort of seeing the sort of slow decay of the economy. Income growth was at 6 to 7, and then 5 to 6, and then 4 to 5. And employment growth was at 500,000 jobs, and then 300,000 jobs, and then 150,000 jobs. And that sort of decay over the course of years is actually very normal for, I'd call it sort of a traditional business cycle. Like, that's how business cycles work, which is, the economy's too hot, interest rates rise, the economy slows down, it takes a while. It's kind of death by 1,000 cuts, rather than some acute moment where it's like, oh, today we walk in and we're in recession. It's not how typical economies work, unless there is an external shock like COVID, or an unusual credit crisis dynamic like we saw in 2008. But neither of those things are, well, who knows if we'll have another COVID? I can't predict that. But certainly we're not in a position to have an acute credit crisis shock right now. So we're just kind of getting slow but sure decay from elevated interest rates.
You talked about how the traders out there really would have done better just by fading, the extreme movements we've seen. We're talking about 10-year yield, 4.75, 4.3, keeps coming back into the middle. We haven't talked about small caps yet, because I think that this is a market that I watch on a regular basis. And what are they doing? I think a lot of it is held by what the rates are doing. And I've been right to some extent on that for a lot of trades, but then you see yields come down, and now you just see the Russell. I mean, today it did go up. It did finally get dragged up and pushed and pulled up almost with everything that the market had to throw at it. But for the most part, they're just stuck. And so many people will say that the small caps are the true sign of the U.S. economy. We've talked about that as well. Is it just a market idea, or is it just a market that without the economy, or is it both? What are your thoughts on this massive divergence with RTI, or RTY, I should say, the Russell 2000 and the NASDAQ and S&P?
Well, the nature of a lot of those companies, something like 40% of them are negative cash flow businesses, puts them at the front end of that decay experience of elevated interest rates, right? Because those are businesses that, at some point, if you're a perpetually loss making business, at some point or another, you're going to run out of money and you're going to have to go to the financing markets, either to the equity market to raise more equity or to the debt markets to borrow again. And so they are the entities, the businesses that are the most sensitive to the structural environment of higher interest rates. And so it's not that surprising, like, that you're not seeing much relief, because for those companies, the reality is the level of rates is, whether it's 425 or 475, it doesn't really matter. What really matters is that they're credit constrained. And I'd say that 40% of companies that's in that index, they are unusual in the overall economy. And the reason why that is if you're a small business, like a true small business, I'm talking about, like, an accounting business, your neighborhood accounting business, those businesses aren't borrowing a ton. They run cash flow positive. Like, you have to run cash flow positive. You don't have any access to credit. So if you're a small business, small entrepreneurial business, you're mostly insulated from interest rate rises. And obviously, if you're a big business, you have access to the credit markets. You've termed out your debt. You often have a lot of cash, free cash flow, et cetera. And so what we're seeing in that index in particular is the sort of the belly of the market that's particularly sensitive to the continuation of elevated interest rates in the economy. And it's going to be tough for those businesses to succeed unless we get a meaningful easing of interest rates without a meaningful deterioration in economic conditions. And that's going to be tough. That's a tough place to be for a lot of those companies.
And so ultimately, we go back to the Fed. If the Fed cuts once, twice, or three times, that actually will have some impact on what happens in those stocks, though, no?
Yeah, I think so. The question is, for what reason? If the Fed's creating easier monetary policy as a function of, let's say, inflation coming down, right? That's great for those companies, because it doesn't mean that they're not experiencing the growth risk, and they're getting the easing of financing conditions. The real problem for those companies is, can they get the easing of financing conditions without getting a growth slowdown? And that's the real challenge. And I think I think the market is sort of staring at that and saying, oof, that's going to be tough to get that combination of events that would make those assets, those companies particularly attractive. I think it's interesting, actually. I was just looking at, my day job is looking at how hedge funds are positioned. And I was just looking at how hedge funds today are actually have their lowest allocation, their most short position on a relative basis for small caps and mid caps than they've had in 25 years. And I think it reflects the challenge that those companies are facing.
Some would say that's an opportunity, right? Because if, I always look at, where, not always, but if you're going to be in a true bull market and the economy is going to be, we go back to having this growth and these earnings, that should help these smaller companies, you would think. Or are we just maybe in a scenario where just the big guys are going to do well in this market, and it isn't an opportunity? Russell's going to continue to struggle because they just can't compete. We're in an environment where they don't play catch up, even in a good economy, just because really the world's changed.
Yeah, and I think that's where the sort of, people talk about the K-shaped recovery. Well, when it comes to businesses, that K-shaped recovery is, positive cash flowing businesses, whether they're big or small, do well in this sort of environment. And negative cash flow businesses do poorly, or those that need a lot of fixed investment, right? Because they need a lot of incremental debt. And so that's the divergence. That's the K-shaped recovery. And so it's less about size, because, as I said, like, actually, if you're a service company, if you're a small service company, actually things are pretty good for you, right? Services demand is quite strong. As long as you don't need any debt, right, you're in pretty good shape. And so that's really that's the K, is the financing need versus not financing need, much less like, essentially the size cohort. It happens to be that small companies are also big borrowers.
So it really is a tale of what we see across the tape this year. I mean, so it's really more of a stock pickers market. even though obviously the NASDAQ has done extremely well and S&P as well. But when you look within the indexes, everyone talks about the lack of participation from this group. Like software and AI lately has just been getting crushed. I know that because I own some of those software companies like Snow or some of these other ones that can't get off the ground. But yet when you look at like an NVIDIA, like we talked about, keeps going higher. So what you're saying is that, yeah, some small caps might do really well. Like you said, it's based upon their business and what they are, and whether they have cash flow or if they're relying on that they need, credit or they have debt, which obviously makes sense in a higher interest rate environment. I don't know if I'd say high, but so that's also another reason why I think this actually explains a lot to me in terms of why the indexes can continue to go higher, Bob, is because, like you said, if you're positioned right in this market and you're a good company, you're doing really well. If you're not positioned right, you're not getting rewarded by this rally.
That's right. That's right. That's where the divergences we're seeing. I think the challenge is that story was a very compelling story when the underlying expectations in the market were that the US economy was going to slow down rapidly, right? And so what we've seen is a repricing of better likely outcomes for those higher free cash flowing companies. The challenge is eventually that those expectations get a little unwieldy in terms of just how high they are. And that's the sort of thing that sets the stage for a reversal. Now, will that be tomorrow? Will it be 3 months from now? Will it be 6 months from now? How many earnings reports do we have to have before before the market investors start to say, are we really going to get the sort of earnings growth that people have talked about? That is, that's the $64,000 question for anyone who's running these markets. It's and it's the challenge for anyone who sits in a position that is cautionary as the market and the expectations just push ever higher.
What gets really interesting in that moment is what happens on the rotation. Do the big winners start to come down, and do the ones that have been struggling get hurt more, or do people come in and buy those? Do we see some sort of rebalancing, we call it, or do the ones that are weak stay weak when the big ones come down? Do we have like this waterfall moment potentially in the indexes because they look around and say, well, really nothing's going up right now. We're not rotating out. And that's where I think it's really interesting, because when you get very much dependent on a specific group of stocks, and I'm not talking about just the 5 or 7. I think just in general, when you have a market that's not just kind of throw a dart at the board and go higher, the indexes can be more sensitive on a rotation lower, just as they were on the rally. And I think that internals are going to matter a lot on the rotation to see what happens, right? Am I wrong in that thinking, Bob? I mean, I'm curious what you've seen in the past in these types of situations.
Yeah, well, I think in this sort of circumstance, if you sort of have an environment where, let's say, in a macro sense, expectations aren't met, then the question is, from a stock picker sense, where do you want to be? Well, where you want to be is a place where the companies that have essentially low expectations but are likely to do well, and you don't want to be in the companies that have very high expectations and are not meeting those expectations. And that is a that is not a sector point, necessarily a sector point. It's not necessarily a size point. It really is, you really do have to, if you're going to try and do that sort of individual stock selection rather than the macro. And I mostly focus on the macro, but if you want to get into the individual stock selection, like, you're going to have to think about what's priced in versus what's actually transpiring with the earnings, who's winning, who's losing. Are your software companies, well, they had high expectations and then AI comes in, and is that going to undercut them? And then, you know what I mean? Like, that's the sort of stuff you have to get into, which I think is, it's kind of the fun stuff, right? In terms of, I mean, for stock pickers, it's the fun stuff. I'm more macro guy by trade, but I enjoy the occasional dipping into the individual company stories.
Yeah, for me on my long-term account, I'm trading in and out of stocks, weekly, monthly, even yearly basis. But as primarily an index trader, it gets really interesting in these moments because, like you said, of all those reasons, it just, when the market starts to pull back, I think even as short-term day and swing traders, I think watching the internals for someone like myself becomes very important, because if those main leaders start to rotate down, does the entire market soft or not? I think it'll determine the weakness overall within the indexes. Just help as a gauge to what happens. I think overall it creates more volatility, which I think the market could use. It's gotten a little stalled. I mean, you can see these moves, these ranges, but the ranges are really from low to high. They're never from low to high, high to low, and back up. They're really just almost up. Not always, but a lot of times. But it's we could use something to shake it up a little bit. I want to stay with the economy and the macro just a little bit with you, Bob. What is your long-term outlook for the U.S. economy right now?
Well, I depends on exactly what you're talking about in terms of long term, but in the next 24 months, like,
Yeah, I would say next 12 to 24 months.
yeah, what we're experiencing is a very typical late cycle dynamic. And it is unusual in the sense of we've typically had, credit driven expansions and contractions like during our professional careers. And this one's different because it's very income oriented, but the sort of shape of it is similar in the sense of, inflation demand was too high, inflation was too high, the central bank tightened, the economy slows in response to the central bank tightening. Those who need capital most acutely are most sensitive. Those who need capital least are least sensitive. And that we're sort of slowly, but very, very gradually experiencing an economic slowdown where, it's not like there's a big bang default going on. It's just like every day there is some company that needs financing or some building that needs financing, that where the financing costs are a little too high and they can't quite push it out, and then they start to they lay a few people off. And that's kind of the story here, which is in many ways akin to sort of an old timey type late cycle environment, which is in those in a, I don't know, the 50s and the 60s. It's not like there wasn't a thing that there wasn't the failure of Lehman, right? That was not the thing that caused the slowdown in the economy. It was just basically like this very slow, methodical, death by 1,000 cuts type environment. And really one in which, in order to get something to accelerate more quickly, we'd have to have a more meaningful shift in asset prices that creates sort of a reinforcing dynamic. And that would have to be significant in order for it to shift. I mean, even if you go back to what we saw last summer and fall, stocks fell 10 or 15% and like nothing happened in the real economy. Now, of course, that was quick, and it bounced because the Fed and the Treasury eased a lot in early November. But that kind of gives you a feel like, absent something that's more meaningful than what we saw in the summer and last fall, we're not going to see the real economy move all that fast. Like recessions, I was writing about this last week. Like recessions don't just happen. It's not like just happens from the sky recession. It just occurs, right? There's a series of normal linkages that occur, which is that in general what has to happen is you have to have a catalyst. That catalyst almost always is asset prices falling. And so you have to have that happen first, like stocks at new highs, bond yields at 430, the Fed basically, and interest rates in general where they were the last 2 years, and income growth of 5%. Like there is no recession coming until one of those things changes, right? That's what has to happen. One of those things has to meaningfully change. Otherwise, we'll be in this slow decay process, which, eventually will slow down enough, like maybe 18 months from now will slow down enough, but not unless there's a more meaningful shift in asset prices or interest rates.
That's what I was looking for from you, was really what you thought about a potential recession, or what would potentially trigger things to set up for something like that. We didn't talk about the election. That is going to become a focus point for traders, I think, soon. What should we be looking for as traders and investors coming out of this election? Does it even matter who wins?
Yeah, I think it's a good question, and one that I think there's a lot of, I describe sort of as lazy thinking out there. It's like, one candidate wants to stimulate the economy and run big deficits. The other one wants to stimulate the economy and run big deficits. I'm not sure if you talk to people who understand the prospective policy differences. In one case, we see the policies in the day to day. In another case, the policies are being drafted. I think there could easily be a more meaningful divergence in policy that matters. For instance, thinking about, how certain behaviors might affect interest rates, right? In one case, we might be talking about on the continuation of the existing administration, you'd probably have continued relatively large fiscal deficits that would continue to put pressure on long-term bond yields as the government continues to issue bonds. On the other side, with a new administration that's more focused on interest rates, maybe with a history of feeling the pain of high interest rates in various business activities, keeping interest rates contained may be more of a focus. And so you might have pressure on the Federal Reserve to keep interest rates lower. You might actually have less desire to engage in significant borrowing activities. And so those two things could be very different from each other. And so I wouldn't just say, hey, look, this is going to be, two sides of the same coin. I would be hesitant. And really what we have to do is roll up our sleeves. Like, we're getting incremental information about the different policy choices that are going on between the two. And policy, like I'm talking like real policy, like actual implementable policy. It's not like vague, statements that are said in some speeches. There's like people who are experts, who are technocrats, who are granularly figuring out these policies, and they're going to talk about their policies. And so you have to go through that process of understanding them. I think probably the biggest thing for the everyday investor is, like, right now it's a coin toss, various models and stuff that have reasonable senses of what the range of outcomes are. Right now it's a coin toss. And so you got to also be careful as an investor, like, unless you have a real edge in figuring out who's going to win the election, you're much better off making sure that you're well diversified and protected around that point, rather than trying to bet in one direction or another, because there's a lot we don't know about what the policies are, and certainly who's going to win. Basically, nobody knows.
Yeah, I mean, nobody knows, and we all know that anything can happen between now and then. So between now and then, Bob, last question for today. What is the trade? Well, what do you think the market focuses on? Or where do you see the most potential, let's say, between now and the election?
Well, I think the challenge here is, I think probably the most potential, I'd say, is to fade extreme expectations. That's what I would say. I think we're going to have, we're going to continue to have sort of whippy views. Everyone's going in one direction, everyone's going in the other over the course of the next 6 months. And so it has been a good trade to not get caught up in trying to run towards extremes in one place or the other. And instead, when you see really high expectations of growth, fading those have been a good trade. When you see very low expectations of growth, fading those have been a good trade. And so maintaining that sort of centeredness of not getting whipsawed by the noise, and tactically finding opportunities to fade those extremes in terms of market pricing, which isn't, at some level, that's a system. That's not that, what I'm describing is, it's not a view, it's a system. And today, I don't know, if I was looking at it, I'd say what's priced into twos seems not particularly extreme in one way or another. What's priced into tens, like, on the margin, I think they'll probably go a little higher, but like, that isn't the real trade. I see more extremity in terms of expectations in the equity market than pretty much any other market. The other thing I'd say is that the dollar looks currently is a little softer than I would expect, given the relative monetary policies going on globally and the relative strength of the U.S. economy. So that's kind of, those are sort of the two areas that look probably the most interesting: fading the equity market surge and going long the dollar.
Yeah, the mean reversion trade. I really like it for, the short-term interest rates or the 10-year, I think, because exactly what you said. I mean, if we really do believe that the Fed is not the story, and we think 1, 2, or 3 at most, and the market's trying to price in extremes one way or the other, like rips up to 4.75 and tens, or you see a 10-year back down to 4%, you think most likely that's too far in one direction. You have a mean reversion trade, and you got in 10 years or 30 or however you trade it. I like that thought process though, Bob, because I mean, the hard one is fading the equity rally, right? Because no, who wants to step in front of that NASDAQ, boy? I'll tell you, but it will be interesting. And I appreciate your insight so much about the earnings next time around. They're not too far from now where they all start to begin. And what happens there, I can't, agree with you more. That's going to really set the tone for the end of this year, because we've had these adjusting of expectations, and you could feel it within the tape and how the rally has run. What do we see in these next set of earnings, especially for these big guys? Microsoft, NVIDIA's actually just had their earnings recently, but I know they're a ways away. But how do they look, and how does it look for everybody else? So, Bob, it's always great to hear all of your insights. I always learn something every time we talk. Before we came on today, I said you're one of the busiest guys out there. I mean, you put in a ton of hard work and effort, and you've made macro a lot easier for someone like myself to understand. So I appreciate you, my friend, in so many ways. And thank you so much for coming back on Futures Radio.
Yeah, thanks so much for having me. It was a great conversation. Really enjoyed it. So look forward to doing it again.